At 2:37 a.m. while you're asleep, trillions of dollars quietly change hands. No alarms, no headlines, no emergency meetings on TV. And yet, this is the moment when the global financial system is at its most fragile, because if this market fails overnight, you don't wake up to a bad headline. You wake up to a frozen economy. This isn't the stock market. It's not crypto. It's not even something most investors think about. It's the overnight lending market. And it can crash the world by morning. Here's why that matters right now. Every modern economy runs on promises. Short-term promises. Extremely short-term. Banks, hedge funds, governments, and massive institutions don't actually sit on piles of cash. They borrow constantly, sometimes for years, sometimes for months. But the most dangerous borrowing happens for just one night. This is the market where institutions lend money to each other after markets close and expect it back the next morning. Sounds harmless. It's not. Because this market doesn't exist to make profits. It exists to keep the system alive. Think of it like oxygen. You don't notice it until it's gone. Here's the simple version. Every day, banks need cash, not because they're broke, but because money moves unevenly. Customers withdraw funds, payments settle, trades clear, payroll hits. Some banks end the day with extra cash, others end the day short, so they borrow overnight. I'll give you cash tonight, you give it back tomorrow morning. And here's some collateral so I know you won't disappear. That's it. That's the entire deal. This market is called the repo market, short for repurchase agreement. One side gives cash, the other side gives a supposedly safe asset, usually government bonds. Tomorrow, the deal reverses. Cash comes back. Collateral goes home. This happens every night, in massive volume, in the US alone. We're talking about $4 to $5 trillion moving overnight. Globally, it's much more. And here's the uncomfortable part. If this market stops working for even a few hours, banks don't feel pressure. They stop functioning. No overnight cash means no ability to settle payments. No settlements mean no trades. No trades mean markets freeze, not crash, freeze. And freezes are worse, because panic fills the silence. Now let's talk about the hidden mechanism that turns this boring system into a global risk. Collateral. In theory, repo loans are safe. You lend cash. You get high-quality collateral. Government bonds, treasuries, stuff everyone trusts. But safety only works if everyone agrees something is safe. The overnight market runs on confidence, not laws. If lenders even briefly doubt the value of collateral, they don't negotiate, they walk away. And when they walk away, interest rates spike. This already happened. In September 2019, the overnight repo rate in the US suddenly exploded. Normally, these rates hover calmly around the central bank's target. That week, they jumped from about 2% to nearly 10% overnight. No warning, no crash beforehand, no obvious disaster. Banks simply stopped lending to each other. Why? Because cash was suddenly scarce. Tax payments had drained liquidity. Bond settlements sucked up reserves. And banks, following post-2008 regulations, were afraid to lend their excess. The system didn't break loudly, it quietly seized. And the Federal Reserve had to step in within hours, injecting tens of billions of dollars just to keep the lights on. This wasn't a recession. It wasn't a panic. It was a plumbing failure. And most people never heard about it. That should bother you, because the system didn't fail due to greed or fraud. It failed due to math. Here's the uncomfortable math. Banks are safer individually than they used to be, but the system is tighter. More rules mean less flexibility. Less flexibility means less trust in emergencies. So when something unexpected happens, everyone protects themselves at the same time, and that creates the shortage. Ironically, the very rules meant to prevent another 2008 made this market more fragile. Now let's zoom out. Why can this crash the world by morning? Because this overnight market is the foundation beneath everything else. Stock trades settle using cash that flows through this system. Bond markets rely on it. Derivatives depend on it. International dollar funding depends on it. The US dollar is the world's reserve currency, but most dollars don't live in America. They live in balance sheets overseas. Foreign banks borrow dollars overnight too. So if stress hits the repo market, in the US it ripples globally. European banks feel it. Asian markets feel it. Emerging economies feel it hardest. This is how local liquidity problems become global crises. And here's where the irony kicks in. This market exists to reduce risk. Short-term loans, high-quality collateral, minimal exposure. Yet it's one of the biggest sources of systemic risk in finance, because it assumes tomorrow always arrives calmly. Now contrast the hype with reality. People argue about stock bubbles, crypto crashes, interest rate cuts. Meanwhile, the most dangerous market in the world operates while you sleep. No apps, no charts on your phone, no retail access. just institutions trusting each other not to blink. And when trust disappears, it happens fast. There's no gradual unwind. Overnight markets don't trend down. They either function, or they don't. That's why central banks obsess over them. Not because they're glamorous, because they're critical. In 2020, when the pandemic hit, this market nearly froze again. This time, the central banks didn't wait. They flooded the system with liquidity immediately. Unlimited support. Emergency facilities. Balance sheets exploded. Not to save stocks, to save the overnight market. Because without it, nothing else matters. Here's the quiet truth. The global financial system isn't as complex as it looks. It's layered, and the bottom layer is fragile. We've built a skyscraper of derivatives, markets, and leverage on top of a system that requires trust to survive each night. Every morning we wake up assuming the deal's settled, that money moved, that promises were kept. Most days, that assumption is correct, until it isn't. And when it fails, it doesn't start with panic. It starts with silence. Phones not ringing, rates jumping, liquidity vanishing. By the time headlines catch up, the damage is already done. So here's the question to sit with. If the world's most important market operates while no one is watching, and it only works because everyone believes it will, what happens the night they don't?